and just been looking at, and David will no doubt update us, but I'm looking at the markets this morning, and I can see that they've been some of the best returns since 1933, just in the last sort of 24 hours. So, we're in interesting times. We've had some significant drops and some significant rises. Most of you know me. I've been an advisor since 2003, and some of you might know my mother, Jenny, who started in 1979 in the business out in Johnsonville. So, we've got a vested interest in making sure that we maintain long-term relationships with our clients. This is going to be probably a new model for how we do interact with a lot of our clients now through this type of platform, particularly in the zone where we're not supposed to be meeting people face-to-face. Social interaction is a shift. So I've been working with, it used to be known as Grosvenor Financial Services, now known as Booster, for about 12 years now. And I've got to know David during that time. David's the principal and shareholder in Booster Financial Services. He's got over 35 years experience in research and investment management. The research part is particularly important, we feel, when it comes to selecting a good fund manager. And he's been the Chief Investment Officer at Booster for about 8 or 9 years. Prior to joining Booster, he's 17 years at Westpac as a financial services area. He's had a variety of roles as General Manager and their Chief Investment Officer. So we're in good hands with David. He's also studied in his background. He's got a Bachelor of Master in, Management Studies degree with majors in economics, maths and marketing. And he is also a football referee. I've seen him out on the field refereeing football games and in Central League football. And he's just recently been appointed by Football Federation Australia as the match commissioner for the Wellington Phoenix home matches in the Hyundai A-League. So that's a little bit of background with David. He's presented at many of the Booster conferences that I've been to, and I've always found his insights interesting and valuable, and I'm sure you'll appreciate the time that we get to spend with David. So that's enough from me today. I'll hand over to David, and thank you for your time.
Cheers, Robbie. This is certainly a whole new world for us, and once we get used to this new surreality, I'm calling it, I think we're actually going to quite enjoy it to the point where our employers, respectively, might find it difficult for it to get us back to the office. Yeah, Robbie was quite correct. Last night, we've had a good rally in the markets, and it just highlights, as we'll go through, that these are going to be very volatile times, and each day is just going to be up and down, and it's going to make it quite difficult to engage in any sort of market timing of any significance. I've talked before about the Market Timers Hall of Fame being empty, and this is no exception. I think Vicky's going to run the slides for me, so maybe we just kick into those. Vicky, if you can.
Yeah, some thumbs.
All good. Brilliant.
Yeah, I'm looking at the presenter's view as opposed to the actual view, but that's all right, isn't it?
Yep, no, that's fine. I think everyone can see the slide at the moment. It's got set your priorities. I think I've got a fairly simple message for everyone today. This is not about focusing on some of the things you can't control, which is the markets. This is very much a time to identify what are your priorities in this particular time. If you just click the button, and this predominantly is about your own personal well-being, your mental health, your physical health, looking after your families. If you just click on next, and with Robbie's help, just focus a little bit on your really short-term goals. And I think at the moment, the priority is just looking after some of the cash flows that you've got to perhaps deal with some of those challenges over the next 4 weeks or so, and just making sure you've done everything you can there. So those are the things you should be focusing on. The markets at the moment, my message is don't focus on them. If you just hit the next button, Vicky, try and ignore this. However, to give you the sense of comfort that I want to leave with you today, that the markets will look after themselves, and those are not the things that you should be worried about right now. I'm trying to remove that as something to be anxious about. Focus on your own personal situation and get yourself comfortable in this new world for the next 4 weeks. And to give you some comfort, why I'm very happy and confident to say that, I'll just take you through a few slides, starting with, so what has actually happened to date? And whilst the headline financial market numbers might look a bit scary to start with, we can start putting them in perspective. I've tried to estimate a little bit where things might have got to after last night, but I think I've been conservative, so these numbers might be even slightly better. But for the year to date, you can see there, depending on which sort of portfolio in, whether you're in a high growth or a moderate, ranging from sort of minus 18%. I'm just going to put my glasses on. There we go, minus 18% to minus 6%. So that's just the year to date from the 1st of January. If we click next, thanks, Vicky. So since the last year, a high growth fund's down about 10%, growth fund down about 8%, a balanced fund down 4.5%, and a moderate fund down just less than 2%. And click on the next, just to also give some perspective, and this is only the last 3 years, despite the fact that the US stock market has fallen 35% or about 25% as of last night. Since March 2017, which is nearly 3 years ago, we've still got positive returns across the funds. So that perspective sometimes just helps you to get away from the very short-term, highly volatile noise that you're seeing from day to day, which is our minds tend to go into that sort of mode when we're anxious and frightened about things. We very quickly lose the perspective and the focus. Just click on the next slide. And in here, you'll start to see some of the real benefits of having a structurally diversified portfolio that is focused on providing a mix of assets that will be as defensive as it can be whilst anticipating and generating growth. If you just click again, Vicky, I just want to highlight, global shares are down about 28%, odd 29%, but in New Zealand dollar terms, they're down 20%. So that 10% difference is because of the structural benefit of having foreign unhedged currency in the portfolio. So that's helped to smooth out about a 10% of the fall in the stock markets per se. So in these times, having unhedged foreign currencies in the portfolio is a great risk mitigator. Down the bottom, you'll see Tahi LP and the Private Land and Property Fund. This is the benefit of having unlisted securities in the portfolios, which we have been progressively introducing into the portfolios for the last 3 years now. Tahi being a vehicle set up to invest in small to medium-sized, privately owned New Zealand businesses. Typically, we're buying these at multiples of earnings of 5 or 6 times. When you buy a New Zealand share, you're typically buying it at 20 times earnings. So we're buying good, successful, solid New Zealand businesses at a lot cheaper prices than you would if they were listed on the stock market. And you can see there the benefit of those unlisted assets in the portfolio structure, a positive return for this year to date. And similarly on the Private Land and Property Fund, you would have seen some advertising on television about that recently. It owns predominantly fixed lease contracts to a range of horticultural industries, predominantly winemakers. And just to give you some comfort, we have received an update directly from the head of the New Zealand Wine Society or Association Manufacturers, who's had a message from the Minister of Primary Industries confirming that grape and wine producers are able to continue as an essential business throughout the level 3 and level 4. So we're comfortable that the grapes will continue to be picked, bottled, and available for consumption through your supermarkets and globally, because trade and transport continues. So we're very comfortable with the underlying assets in those portfolios. Similarly, fixed interest, you can see there, has been quite solid. Let's go back a year, a similar picture. If you just click there, Vicky, you can see the global shares down 17% for the year in local terms, but when you introduce the currency effect of that, the unhedged element, because the New Zealand dollar's fallen 10% in this environment, global shares in New Zealand dollar terms are now only down 7.5% for the year. And similarly down the bottom, and click again, we've got the grouping of structurally defensive assets that have really come to the fore in this environment, with the private land and property portfolio up almost 10% over the year, and fixed interest doing its job to mitigate some of those risks as well. If you again, just go back 2 years now, and you can see the numbers are very manageable and reasonable. So this is literally just a 2-year performance. Global shares in New Zealand dollar terms, despite the fact that the markets have fallen 30 to 35% since the middle of February, are up 1.7% over the last 2 years. So someone who's got a long-term investment horizon and started a journey 2 years ago, quite literally, if you had been out of touch with what's been going on and we're just logging in now for a client update and we're just seeing the last 2-year performance numbers, your reaction would probably be, oh, it's fairly muted, you know, got 10% return from here, but I'm okay. You would know nothing about what is going on in the markets, and that's the benefit of that perspective. So let's go on to the next slide. The global shares performance. So this is where actively managing portfolios really starts to demonstrate its benefit in this environment, as opposed to just slavishly following markets. So we just start to click through here. The first row on that slide, the global shares, this is just the month of March itself to the 24th. I've tried to get the best estimate that I could. So global shares in New Zealand dollar terms just for this month are down about 19%. One of the key investment managers we use in our portfolios is a crowd called Fisher Investments in California in the United States. Their portfolio is down just under 17%, so over 2% better than the market. Magellan is a fund that we use not in KiwiSaver but in our non-KiwiSaver funds. They're down 13%, so 5% plus better than the market. We have a structural exposure to gold miners, which we put in place some time, and they're only down about 12.5%. The most positive impact we're seeing through this period is our global direct share portfolio, which we've had a relationship with Rothschilds over in Zurich for 15 years now. Their portfolio is only down 12% this month to date. In fact, I think we got an update yesterday which says that they're about 10% ahead of the marketplace. So that's really strongly come through. And then the last part there, we've got a structural exposure to the US healthcare sector, which we've had in place for a while. It's one of those key defensive ones, as you can imagine, in this sort of environment. Whilst the markets are down 20%, healthcare stocks are only down about 10%. So collectively, that is feeding positively into the portfolio structures, and this gives you a snapshot of all the shares that we have in that direct global share portfolio that we put together with the advice from Rothschild. So all those green bars are those stocks performing better than the marketplace. There's about 20 stocks in that portfolio, and you can see there's only 3 of them that have actually done worse than the marketplace. And not surprisingly, it's a company like Total, which is involved in the oil industry. So very strong outperformance from a defensively structured portfolio in this type of environment, and it will continue to do well as we work through the longer term impacts of what this shutdown is going to do on company earnings going forward. So we're very comfortable with the underlying portfolio structure there. I just want to really hone in on the longer term with this and why your priorities should be on other matters and just let the markets do their job. This chart here is a graph of the US stock market, that red line, the S&P 500 index, going back to the 1900s. So we've got 120 years of data on the US stock market, which gives us a lot of key critical insights into how markets perform in various scenarios, particularly during these sort of crisis times. I just want to highlight that blue series of bars there represents the rolling average return over 15 years for all of the 15-year periods that we have in the database. And you can imagine over 120 years, we add a month on, drop a month off, and just keep rolling that 15-year return per annum all the way through the data, and you can just plot the outcome for someone who had a 15-year time horizon. So that little dotted circle that we can highlight there, that is the only period where the rolling 15-year return just touched 0. So another way of looking at this, over the entire history of 120 years of the US stock market, there's only been one period where the return touched zero. So one can confidently assert that over rolling 15-year periods, you do not expect to get a negative return. And let's just hone in on that 15-year period. As you can imagine, that was around the Great Depression. The market fell from 1929 to 1932, over that 2.5 or 3 year period, a whopping 80% during the Great Depression, the US stock market. It was absolute carnage. And then over the next 12 years, it rallied. If we click the button again, up to the point there where it reached the point of the peak in 1929. And so that's the worst 15-year period that anyone has ever experienced in financial markets. So we're talking about an 80% fall in the market during the Great Depression. And then as it was coming out of that, the recovery, the end of that 15-year period resulted in falling right into the middle of World War II. So hard to imagine two massive events impacting the market more in our history than those two. And yet the 15-year return was still not negative. So we can take that confidence and knowledge into today's environment and try and think about, so where will the market be in 15 years' time? I'm not going to stand here and pretend to know where it's going to be tomorrow or next week or next month or even at the end of the year. But what I can do is give you a very confident forecast of where it'll be in the next 15 years. So for those of you who have got that sort of time horizon, it becomes a bit of a no-brainer. You just click again, Vicky. So we can see there that line represents the 15-year period from 1929 to 1944. And so I've put that line again on the top of the right-hand screen, which is representing where the market peaked in January of this year and has subsequently fallen about 30-odd%. So my confident forecast is I can tell you where the market will be as an absolute minimum in 15 years' time based on 120 years of history. So if we click that button, that point there is where I'm forecasting the market will be as a minimum in 15 years' time, i.e. back to the level it was at the peak of January of this year. And that's a 40% increase over that 15-year period, or about 2% per annum. That's the minimum return that I would expect. And that's irrespective of how it gets there. It would be very confident to suggest it's going to follow that line, that dotted line, just straight up from here, the market's bottom, and it's nice and easy. Even if it repeated what it did in 1929 to 44, which is the next dots, let's just assume it drops some more. My forecast is that it would still be back to that point in 15 years' time. That is the history of markets. They are a very great barometer of recovery and demonstrating the resilience that's in the businesses that represent the companies in those index. So that's my most confident forecast. Just click on forward. I think one of the very significant key things to recognize now, given what we are going through, which probably wasn't even available to governments back in 1929-30 during the Great Depression. And not only was that sort of a US-focused depression situation, but we're talking about a global pandemic that has global impacts. To give you an idea of what governments are doing at the moment in response, if you just click the button, they are absolutely, oh, I'll just go back, sorry. They are absolutely throwing the kitchen sink at this. Those bars represent the amount of stimulus that each of those governments has pledged as a percentage of their GDP. So you would have seen New Zealand's package announced the other day, which continues to increase as we speak, representing about 4% of GDP. You can see New Zealand just to the left of centre. But look at the left-hand side. Germany has pledged to spend 16% of their GDP in support of this. And in fact, last night announced they're going to 30%. they are pumping in the equivalent of 30% of their annual GDP via stimulus. And the whole world is doing the same. New Zealand has not stopped. The whole range of central governments and banks around the world have made it categorically clear that they will do whatever it takes. So you're hearing statements coming out of many countries now saying their commitments are infinite, they're not putting a cap on it, and they'll just do whatever it takes. That provides a huge amount of confidence. If you click on the next slide, you might ask the question, well, how on earth does anyone afford to do all this? And let's look at New Zealand, because it's a little bit easier to focus on and say, where is the government magically going to get $12 billion from, and how do we pay this back? New Zealand's in a very fortunate position, sorry, we should go back, that our current debt to GDP ratio is one of the lowest in the OECD. You can see there it's only about, it's under 10%. The global average is around about 70%. This government has the best amount of headroom to support our economy with whatever it takes. So we don't need to worry about Jacinda and Grant Robinson announcing a $12 billion support package, and then a couple of days ago suggesting that there's no cap on the business support, that's going to cost another $4 billion. They could probably pump around $50 billion into our economy to support whatever it needs to do to support it over the next 4 weeks, and still not be stretching their debt to GDP ratios. So I'm absolutely unconcerned about how this all pans out down the track. What I'm most encouraged by is that governments recognise the seriousness of this position and literally are going to be doing whatever it takes. So I'm comfortable that whilst we're all going to take a very short-term hit in our own personal incomes across the board, and businesses are going to struggle, that the governments will enable them to come out this from the other side in 4, 8, 12, 16 weeks, whatever it takes, once we get clear indication that this virus is under control. I think it'd be fair to say that last night's move up in the stock markets of around 10% on average across the board, and we saw it again in New Zealand, is a direct reflection of the markets realising the significance of the fiscal support that governments have pledged to do to get us out of this, and recognising that, hey, this is going to make a massive difference. I'm not going to spend a whole lot more time on all of that sort of economic market information. I think it's important that you guys get some comfort that the investment markets themselves will look after this through the mechanisms that have been established. There is plenty of liquidity. The markets will look after themselves. Your priority should be to take care of yourselves, your family and your friends. I heard that having a cup of positivity or a cup of tea is actually a good personal thing to do anyway. So just grab a nice hot cuppa. I've got one here. I've had all morning, although it's not as hot as it was when I started. So do that. I'll leave you, you've probably seen this prose that's circulating around the internet. I'm quietly, personally very excited and interested in this massive social experiment that we're about to be all a part of. And I think we're going to come out the other side of this, and however long it takes, a very different, wiser, kinder, more focused on what's real and identifying what's not and what's important, simply as a result of shutting ourselves away for 4 weeks plus and having a real good think about life. So if you haven't read this little piece of prose, it was put together by somebody who'd already been self-isolating, just thinking about what the implications of this might be. And I think there's some really strong, solid messages in there about the impact of this on a social level. I saw some photos this morning of just the latest photos of Venice, and extraordinary clarity of water in the canals. It just makes you realize, and this is a really strong indication of if anyone had any doubts about the human impact on the planet. So there's going to be a lot of thought being given over the next 4 weeks to how this new reality actually becomes quite a lot more permanent, particularly in its implications for how we deal with each other and how we deal with the planet. So I'll just leave it there for now, and I'm very happy to take as many questions and for as long as you want to, because we've all got plenty of time now.
Thank you, David. A couple of questions that have come in, and you touched on it a little bit, is the value of having an active manager versus a passive manager, and that might mean something to some people or not. So in reasonably plain English terms, could you just give us a bit of explanation about the difference between the two and where this really starts to come in this particular environment?
Yeah, so those are sort of the two binary styles that are often talked about, active or passive. We've never been a fundamentalist on that, and we've also always thought and believed in combining the two together. The passive component just gives you the pure market exposure, where you typically just go out and buy a market index. You're not trying to work out which particular stocks to buy in a market. You just buy a fund that exposes your portfolios to the entire list of companies that are listed on the stock market, and you're not looking to pick and choose. And you do that across the board, and voila, you have a portfolio of index funds that just follow the markets up and down, and whatever the market does, your portfolios do. That's the passive approach, and we have got some passive components to our portfolio. The Vanguard index funds, for example, are fairly typical. So if the US stock market goes up 10%, the Vanguard US index fund will just go up 10%. And similarly if it goes down. So the active parts are the pieces I talked about before, where the index has gone down 19% in this month. The active part of our portfolio is only down about 10%. That's a massive positive impact on a portfolio. And we've always said that the active components are the pieces that really come into their own when markets go through the short-term volatility. They don't demonstrate value too much on the way up. A rising tide lifts all boats. You've heard these expressions. It is not easy to outperform a market on the way up because everything just goes up, but it certainly comes into its own in a down market. I've seen some numbers just to the end of the 20th of March. We monitor what's happening in other KiwiSaver providers on a daily basis, and the numbers that we're seeing to date are suggesting that our portfolios on average across the different profiles are about 2% ahead of everyone of the average.
We've got 5 minutes, David. A couple more questions if I could. Any thoughts, predictions about house prices in the short, medium term, 6 months, 1 year, 2 years?
Yeah, short to medium term, the lack of activity is going to be very difficult to get a good read on it. But depending on how we get out of this, if the support packages are as significant as the governments are suggesting, plus the mortgage relief that's been announced as well, I think that's going to take real pressure off home owners and even investment owners to service the debts around their mortgages. So that does alleviate the likelihood that we're going to have a whole lot of forced sellers. I think in the absence of that, it would be fair to say that we were likely to see longer term house prices coming off. But typically, even in a worst case scenario, if that support package didn't feed properly through to the people who need it the most, and there were some forced sellers down the track, the history would suggest that the house prices may only come off sort of 10%-ish. So again, same sort of story. If you're a long-term hold of property, just see it through. And if you're in the fortunate position of thinking about buying, there's going to be probably some opportunities to pick up some houses. The froth did need to come off some of those prices, so a better housing affordability is going to be good for everybody.
Thank you. Another question. Jim, it's recommended to stay the course with existing investment risk settings, and that's obviously our relationship with the client is the appropriate funds for them. From here on in, would you recommend any new KiwiSaver funds going to a conservative risk level, or stick with what we've been using so far, such as balanced and growth? And I guess probably that's
Yeah,
more of a question for me as much as yourself, but I'm interested to hear your
yes,
thoughts.
it probably is. I think, yeah, I mean, you'll work with everybody in terms of just reaffirming what their risk profiles are. Interestingly, we're keeping an eye on switching activity within all of our funds. Because we have got most of the clients in our portfolios have got advisors like yourself who are there to talk through it. Our transfer rates and switch rates from the higher growth funds into the lower ones are quite low. And in fact, we've got, as a default provider by the government, quite a number of people who have been in those default funds for quite some time. We have been encouraged to find people ringing us up from the default funds who are asking, is this a good time for me to go into the higher growth, geared growth? And we're saying, yes, if your time horizon is 15 years plus, this is a fantastic time. So I think that's important. If you've done your budget and continue to be able to support the contributions, then dollar cost averaging into this sort of environment is another great strategy as well. You're buying low as the market goes up and down. So yes, I think the key thing is that if the risk profile is the appropriate one, it's very much the appropriate one now, and indeed may well be that if there was a tossing up between perhaps balanced and balanced growth, this is not a bad time to start biasing yourself towards the balanced growth one.
Yeah, excellent. We've got about a minute before we need to end the call. Anyone have any final questions or parting comments and words that we'd like to make before we go? And we will do another one of these calls again soon in the next week or two. Just quickly, as a business here, we're going to be continuing to work through either from the office location here at Beattie or from home. So from our perspective, things will carry on as they are. And it'll be the same for you, David, and the team at Booster as well. Yeah. And I guess for many on the call as well. So things don't stop. The markets are moving. We're here. We're committed. We're interested. We're following. We're watching, and we're thinking about the long-term plan and how the impact of the markets are going to affect you personally. So my job is to work with you personally, and David's job is to do all the research and work with the team behind the scenes. And we'll just have
Don't be alarmed. Just one final comment I was going to add, Robbie. Don't be alarmed if you see more really bad down days coming up. We saw a positive 10% last night, but we're not through this yet. There's going to be some more bad days, and the headlines are going to be horrendous. The best thing I can do is suggest you switch off your market monitoring devices. I certainly recommend you keep looking at your KiwiSaver balance every day. It's going to be a roller coaster.
And don't stress it. One guy wants to know the winning lotto numbers for Saturday.